Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us on this Friday. Coming up on the show today, Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy, will be joining us for the hour. In 30 minutes, we'll be joined by Randall Bartlett, Deputy Chief Economist at Desjardins Group, to break down the latest GDP numbers from StatsCan. And of course, we want to hear from you this morning on First Call. Reach out with your questions on North American equities, and we'll have Andrew answer as many of them as he can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. Our email address, if you want to go that route, firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. Laurentian Bank posted weaker than expected second quarter earnings as the bank set aside more money for potentially bad commercial loans. The bank says provisions for credit losses rose during the quarter, driven mainly by higher reserves tied to impaired commercial loans. In 2025, Laurentian announced a deal that would see the bank split up and sold, with its commercial operations going to Fairstone Bank of Canada, while National would buy the retail and small business segment. Apotex has filed for an initial public offering in Toronto, setting the stage for one of Canada's largest stock market debuts in recent years. Bloomberg News has reported the company could raise between $750 million and $1 billion through the offering. The generic drug maker says the IPO will include newly issued shares as well as shares sold by controlling shareholder SK Capital Partners. Bloomberg News is reporting that Chinese-made EVs have started to arrive in Canada. It says a vehicle carrier called Globus Treasure had a small number of the Chinese-made Lotus luxury cars on it when it departed from Shanghai and is now moored outside of the port of Vancouver. They'll be the first imports under the new deal that allows up to 49,000 Chinese EVs in a 12-month period at a lower tariff rate. All right, now our top line story. SpaceX is now targeting an IPO valuation of at least $1.8 trillion, pitching itself not just as a space company, but an AI and data infrastructure giant. Now, at the same time, Dell shares are surging after forecasting $60 billion in annual AI server sales, pointing to relentless demand for the hardware powering the build-out. So what does this wave of AI spending say about where markets are heading and whether the valuations are justified? We're going to get an answer. Andrew's already gearing up for it. He's sitting there. He goes, I'm ready. Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Andrew, thanks as always for joining us.
Oh, pleasure being here.
And I think you have an opinion on this.
Yeah, I mean, 1.8 trillion. It's only 1.8 trillion.
And they dropped down 200 billion.
Yeah, I mean, a mere 10%, right? I mean, it would have been a time, Roger. 1.8 would be unbelievable for any IPO. And now 1.8 is, well, I guess that's what it's worth. We've got tech companies now that are going to come out with IPOs close to $1 trillion to start, right? I mean, so, it's a totally different world for investors right now. We throw 1.8 trillion. Is it worth it at the end of the day? This is probably one of those situations where I'd say probably is. Right?
So I want to ask first about the 1.8. It dropped down from look how we throw these numbers around, 2 trillion down to 1.8, which is a 10% decrease, but not really. I think everybody's kind of breathing now and going, okay, let's be realistic.
Yeah, some of that could be that. I mean, is this going to be oversubscribed or not? I mean, we've seen a lot of deals, Roger, in the past where, the demand for the deal at the time of the deal was so huge, the valuation was so massive, that we go back and say, well, that could have been priced better, from the company's point of view. And I think here's a situation where, from a SpaceX point of view, look, 2 trillion, 1.8 trillion, we know the demand is going to be there. We know the cash is on the sidelines waiting to be deployed to this. And I think, unlike AI, where we can probably pick some holes, depending on the company we're looking at, SpaceX does have that footprint. It has a market share. We had tragic news this morning with a competing company with respect to the explosion.
I was talking about the explosion, right?
And, not to make light of that, but I mean, I think it's just a reinforcement in the investor's view that SpaceX right now is it. This is a company, if you want to play that sector, this is the one you're going to play. So yeah, I think the deal is going to be, when it does come, it's going to be well eaten up.
And is it a space company or is it an AI company?
I think it's both, right? It's tech and it's space. It's commercial. It's transportation storage. I mean, it's all the above.
Yeah.
And there's no other competitor really in that space, right? And that's why, could they just have left it $2 trillion? We'll see where we go before we get to the deal.
And then we'll find out in a couple of weeks, I think, right? June 11th is the day for it. Now, on the other side, Dell, some of the numbers, it was up 37% at one point in the pre-market on its numbers. People kind of, it seems like people forgot about Dell, but all of a sudden they're going, hey, we're here and we're in it.
Well, we talk about FOMO, Roger. So we talk about, from the investor point of view, I'm afraid of missing out on this rally, so I'm just going to keep buying into the stocks. Well, the same thing is happening in this space where companies can't afford to not be investing in AI infrastructure. And Dell, at the end of the day, offers servers. I mean, we think of Dell as being, well, they have those computers, right? We used to have back in the 1990s.
Yeah.
No, this is a massive server company, and they are well positioned in the AI space. And if that demand for infrastructure continues to grow, they're going to post numbers like this. Why the market's surprised by this is surprising in itself, where analysts really got this wrong in terms of the miss on the upside.
Yeah, because they got it wrong by, they were off by about 20%.
Well, that's what I don't
I was doing some
understand.
quick numbers there. It was about 20%.
So massive numbers. We're up north of 100% year to date. To your point, 37, 38% on the day. We'll see where it closes at the end of the day. But and we're seeing this, back before the war started, back before Iran, we were worried about AI. There were concerns about monetization. There was concerns about, are these companies going to deliver on the infrastructure spend that we're doing? Well, we're right back at it now. The war's still going on, but let's just go back to AI. And AI now has become a positive development for the market, not a negative drag like it was.
And are we going to see more numbers like this with different companies that maybe people have forgotten about, like Dell's?
Well, I'll say one thing, Roger.
And they're looking forward. They're pretty optimistic going into right through 2027.
The forward guidance from this report, I think, is really what has driven the stock this morning. The numbers themselves were good. The guidance is really what is driving the stock. What this will do, it will raise the bar for the next guy that's going to report next week, 2 weeks from now. And that could be an inherent risk, right? Because not every company is going to shoot the lights out on revenues. And so we may be setting ourselves up for, well, I'm going to expect this from the next one, and it doesn't happen, and that stock gets punished. So I think you got to prepare yourself for some misses here. But this bar
may not necessarily even be misses. They just may not be
they just won't
as
blow
big
the
as
lights
what
out,
people
right?
wanted.
Yeah, exactly.
We see it with NVIDIA. We see it with stocks like that where they have great numbers and everybody goes, why aren't they better?
Why aren't they up like 60 billion and why are you up only 30 billion, right? So the same thing.
Where do you think we might see something like Dell, like another blowout like this coming from a surprise place?
There's a whole host of them, right? I mean, look at Broadcom, look at all these companies that, once upon a time were downtrodden. These were companies that were not executing on AI the way the market wanted, and they were underperforming to the likes of NVIDIA. These companies now are showing their strength. So hard to say, but I think, you will see some more numbers like Dell, I believe, but you are going to see some misses too.
Yeah, it's kind of inevitable. All right, we'll take a break on that note there, but up next, we will take a look at the markets before the bell. Okay, let's see how things are shaping up on the markets. We'll start with the U.S. futures, and no real surprises. You can see they're up, not as much as you might have thought with the NASDAQ. It's only pretty much a wash, up by 0.08. S&P 500 up by 0.13. News of the talks continuing between Iran and the U.S. that there may be an extended truce or a peace agreement. We'll have to see what happens with that. I think the markets are waiting for more details on that. Over to Europe now. And the European stocks. And the European stocks, you can see a little bit of a mixed bag. Germany, the DAX is a wash right now. The FTSE, though, up by 0.22. And the CAC 40 up by 0.6%. So heading to Asia quickly. And look at the Nikkei surging into record territory, up by 2.5%. The Hang Seng is also up by 0.7%, and the CSI 300 off by 0.45%. Let's take a look at what the TSX did yesterday. And closed the day up by 0.3%. Not quite a record high, but fourth largest, of course, the record set on Monday. And it improved commodity prices, what was helping with that one. Let's take a look at some of the movers and shakers from yesterday. Curaleaf up by 11.4%. Go Easy, 9.3%. Those two on a roller coaster over the last few weeks. CIBC, off by 5.4% after reporting earnings. And ATS, off by more than 14%. Off to the metals now, and gold rebounding a little bit. Up mid-range of 4,500, up by a half point. Silver, 75.60 up, 68 up by 0.31, and copper's at 639 up by 0.6%. And oil, here we'll see some differences here. Taking a look at Western Canadian Select from yesterday. It went up yesterday, 1.58%. Expected change for that today. And here's likely what you'll see, WTI off by a point, down below $88 a barrel. While AI dominates the headlines, one sector is seeing steady, quality-driven demand. Senior living, an aging population, is pushing occupancy higher amid tight supply. To break it down, let's bring back Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. It feels like this has been a growing market for a very long time.
Well, it has been. And it's one of those sectors, Roger, where we get caught up in other sectors that are growing. We talked about FOMO before the break. Mm-hmm. A lot of investors are like, I've missed out. I've got to get back into this AI thing. Do I buy now? Value, take a look at Dell. I mean, Dell's off the charts. Yeah. I'm going to go buy Dell today. But it's really good to step back and say, well, there's other sectors in the market that have these strong fundamental underpinnings that don't go away in a couple of weeks. It's not like a switch like we can see in AI. And one of those is senior living.
But they're not sexy.
They're not. They're boring, right? Yeah. We talk about demographics. There's more exciting things to talk about today. But it's true that the aging population continues. It's going to continue to increase demand for companies that are in that space, whether retirement homes like Chartwell, products that enhance our life as we get older, where we need assistance, whether it's getting into a car, a vehicle, taking a ride up our staircase because we can't walk the stairs anymore. And these companies continue to deliver. They were hit back, obviously, in COVID. When we go back, we saw valuations decline. But these companies are now showing strong growth. We've seen a bit of a setback in the last few weeks. But I think it was just good to kind of step back from the AI craze for a bit and say, what else is out there which is a little bit more proven?
Now, what kind of an impact does our population growth is still, it was negative, actually. What kind of an impact does that have on it? That we're not seeing a growing population. So does that change it, how people approach those sectors?
Well, depending on where the growth is coming from, right? So if the growth in our population is coming from predominantly younger immigrants that are coming to Canada, I would argue that's really not going to have a huge impact because the time delay for those individuals now to feed into this demographic strategy is a long time. If our population growth is because we're not bringing in enough 50-year-olds, well then, that might matter. But I would say it's kind of irrelevant at this point. What is in the pipeline is in the pipeline. The population here is getting older and is going to demand those services and those products. If you take a look at some of these senior living spaces in Canada right now, we're at capacity. We see it in Peterborough, we see it in Toronto. The waiting lists. I spoke to a client the other day looking to get into a retirement home. It's 3 years just for an independent living space.
And what level is that? Mid-range, lower level, upper level?
That would be like a mid to
point?
Upper level, right? So someone that's looking to spend anywhere from $5,000 to $9,000 per month to have a good quality home to be in could be waiting up to 3 years to get into that place. So people, guess what, are doing? They're putting their name on the ballot, 3 years before. And I think builders now are going to respond to that. And I think we'll see increased building in that space. But the companies that are there right now are delivering, and I think will continue to deliver.
And I guess, and buildings, like when they're building, because it's an expense, it's an outlay, but it's also convertible, isn't it, into something else?
Well, exactly. And so what we see, again, going back to Peterborough, we've seen conversion of old hotels into senior living. Right? You see a lot of that. And we see it, you'll see it in Toronto, where we've got a space that is just not providing revenue anymore. Well, why don't we just convert it to senior living? Because I know the demand. It's almost like student rentals, Roger, right? So if I've got a rental unit situated next to a university, I'm pretty much guaranteed rent. Same thing with senior living. So yeah, no, we see the sector is continuing to show strong fundamentals. Yeah, to your point, is it a little bit more boring than talking about Dell this morning? Yeah, but
making money is not boring, though.
It's not, and it's interesting. In the last few weeks, where we've seen the S&P 500 rocket higher, I mean, these particular names have pulled back to points where I think offer some opportunities now.
And what about from the mobility, like the mobility products and things like that? What kind of how does that compare to the shortage in the housing?
Well, again, it's not the same story, obviously, in terms of shortage. Again, it's boring. What I'm interested in going forward are the companies that will actually use AI to integrate into whatever products and services they're offering right now to seniors to enhance their living. We've seen this in the Alzheimer's space, where we're now developing augmented reality for individuals with Alzheimer's to help them get around the house because they can't do it like they used to do it before. So companies that come out with those products, I think, will be interesting to watch for.
And cutting edge, because the people who are aging into those places will be aging in with AI and won't bat an eye at it, will they?
Exactly.
And what about drugs and pharmacies, things like that?
Well, that's always going to be there, right?
Yeah.
And so I think that's a mainstay. The companies that are in drugs that are going to be directed more towards seniors or more towards dementia and Alzheimer's, that demand will continue because unfortunately we're seeing those trends increase as well, right?
Yeah.
But yeah, I think in terms of just looking at the broader space, and the one thing I'll mention, a lot of people don't realize, if you take a look at healthcare, especially in Canada, where I'm buying into pharma, drugs, and all that, well, healthcare actually includes seniors living. And
really? Okay.
When you break these indexes apart, break these ETFs and mutual funds apart, you will find a lot of these companies. So healthcare plays are still a play into senior living.
All right, we'll wrap it up on that note there, but lots more to talk about with Andrew to see why Celestica is on his radar. Time to see what's on the radar for Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. And first up, Celestica showing up. Why is that?
Well, before we came on air, we were talking about that FOMO thing with respect to Dell and these AI equipment makers that are blowing the lights out. So Celestica is in the AI business, basically specializing in switches that are going to go into data centers, right? So they partner with the likes of AMD, they partner with the likes of Intel. Well-positioned company. The stock has been trading off, right? So this is a company that's actually broken the trend when we look at some of the other AI blockbusters in the last few weeks. Stock trading now below $500. So to me, this is a stock that's, for a Canadian stock, is really well-positioned. And one of the new things that they're going to be getting into with their partnerships with AMD is optical bundles or optical switches that will allow more efficient transmission of data, which is where we're going to go to next, right? Because we can build out the data centers, but we're still based on copper and everything else. Optical, I think, will be that next step forward. And Celestica, I think, is well positioned to take part in that.
Not concerned that it might be another fiber optic from Nortel, something like that?
No, we try not to think about those
We try not to think about those things,
We try not to think
right?
about those things. No, I don't think so. I think, again, I mean, now, I've been on the show many times before where I said, are we getting carried away in terms of what we're expecting out of AI? To some extent, maybe. But for a company like this, which might actually have its hands in a newer technology in terms of switches, I think actually that will compensate. So yeah, I think this, for investors that are saying, like, I wish I'd bought Dell yesterday.
Yeah.
Those types of individuals can still probably find some value out there in companies, and surprisingly, a Canadian company that just might have that niche that could provide some growth opportunity in the stock.
And where it's up, what, 200% almost for the last year?
Yeah, we talked about Dell before. 3 years ago, it was $45 a share, right? And now we're north of 300. So yeah, there's a lot of companies that we can look at that are up, exponentially. But the stock has come back in the last few weeks and might be giving us that opportunity.
I was just looking, and they're building they're building a center down in Fort Worth, a facility down there to try and keep up with demand.
Well, exactly. I mean, this is a Canadian company, but it truly is a global multinational company at the end of the day. It has a footprint in the States. It has a footprint in Europe and Asia. So, you're not just buying something, we're making stuff in Canada and hopefully someone will buy it. they are well positioned in the areas, to your point, where we're seeing that demand and we can't keep up with the demand, at least today.
All right. Cameco's next. What's going on there? What do you like?
Cameco's the same story, slightly different. How do we power the data centers, right? And as we've seen, data centers are increasingly looking towards small modular reactors, nuclear power, everything, because there's a shortage of energy to power these mammoth buildings. Cameco is going to capitalize on that. It's going to capitalize on countries around the world now that are converting back into nuclear. Think Germany, which basically jettisoned
shut down pretty much everything.
Its nuclear infrastructure, now being forced to go back to that. And the stock has shown strong performance. A lot of people think maybe it's a little bit overvalued, Roger. I think this is a demand story that continues for quite a while.
And not worried about, because it's 10-year build-outs for nuclear, even for these modular reactors. It's a lot of work, it's a lot of planning, and not concerned that things may change and people start scrapping those ideas?
Well, you know what? If you could tell me the Iran war is going to be over tomorrow morning, I'd say,
it's going to be over
maybe,
tomorrow morning.
Right? Thank you. The thing is, the Iranian war has basically told us that, look, we've got some major supply issues.
Yeah.
We cannot be as confident in the supply of traditional energy sources as we once were. And that is not going to go away tomorrow. It's not going to go away in the next year or two or three or four. And so I think countries around the world and companies are going to say, look, it could be a 10-year build-out, but if I don't start now, then 10 years from now, I could be in a worse situation than I currently am. And so therefore, 10 years, fine. I'm going to start today, and I'm going to need some uranium to power the plant. So.
All right. Tourmaline.
Tourmaline, again, we've had this in our portfolio for quite a while. As we talked about in the show before, Canadian energy company, 80% of which is a natural gas play. Why do we like natural gas? Well, again, let's go back to the Strait of Hormuz.
Yep.
What's your energy supply line look like now for liquefied natural gas? And we look at gas prices when we look at Canadian companies, Roger, and gas prices are up actually quite a bit in the last little while. They're still lower than what we can get in the global markets. And those are the markets now that Tourmaline are starting to supply into. So they're getting that added benefit of, I don't have stuff going through the Strait, but I've got the stuff that people that are not getting the stuff from the Strait want to buy, and I'm getting that extra price increase. So we like it for that. We like it for the dividend yields. And again, it's one of those things that, this is not going to be over in the next few months.
Do you think we have the political will here, though, to up that with the natural gas and oil and just in general? I mean, we're seeing it. It's been some interesting conversations over the last couple of weeks.
You and I talked about this last time I was on the show.
I think it's
every time
I think this is a conversation.
No, I still believe deep down as a country we've got the political will to do it. Is it smooth sailing? No. Do we execute the way we should be? I mean, if you and I were just running this, we'd probably do it a little bit differently. But I do believe that deep down we do have that will. And again, the market's there. So you either participate in this, or you basically leave cash on the table tomorrow. And I think as a country, it's kind of a mistake to leave cash on the table.
Well, I mean, and we really, Carney has said we are an energy superpower. I mean, between oil and also nuclear. I mean, we are still one of the leading countries when it comes to nuclear.
We are. I mean, it's not a fallacy, right? I mean, we are, and I've said this many times. I mean, you can have a tanker stuck in the Strait, or you can have pipelines that are getting product to the world that are willing to pay very good prices. I mean, airwaves say all over how Brent crude has collapsed. It's the worst decline since 2020. Yeah, we're still not north of $90. Yeah. We were $50, $60 a little while ago. So I'll take that price. I'll take the worst decline since 2020. Thank you very much. Right.
People get used to certain prices, that pressure thing. Okay, still ahead. We're going to break the GDP data with our next guest, and our phone lines will open soon for our first call segment. Reach out at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Well, Stats Canada has just released the latest Canadian GDP numbers for the month of March. And I'm just going to bring in now a couple of them while we bring in our Randall Bartlett, Deputy Chief Economist at Desjardins. Randall, join us here. Just some of the numbers. Real gross domestic product unchanged in the first quarter of 2026 after declining 0.2 in the fourth quarter. Decreased business and government capital investment was counterbalanced by higher household spending. Final domestic demand edged 0.1% lower, and I think the survey was 1.5%. Imports rose 2.9%. Roughly half of the rise coming from intermediate metal products and waste and scrap metal, both of which were driven by gold imports. What else do we have here? Lower business investment in engineering structures more than offsets increased spending on other capital assets. Those are just a few of the numbers. Randall, I know you're looking at them at the same time as us. Initial reaction to that first number, the negative 0.1%.
Yeah, I mean, that's a big surprise. Nobody saw that coming. When you look at the distribution of consensus, everybody was in positive territory. The median of consensus was 1.5% annualized increase in the first quarter, and that matches what the Bank of Canada had too back in its April monetary policy report. So, big surprise there. Not something that folks had expected, and I think maybe even bigger in terms of a surprise is the fact that we saw domestic demand edge down in the first quarter, despite the fact that we had higher household spending, and it was really on the government side of things that we saw it edge lower, despite the big increases in defense spending. And of course, on the trade side, we had expected a drag due to much higher imports in the early part of the first quarter, and so that played out. But it's really that headline number and domestic demand underneath it, both contracting slightly in the first quarter.
So, Randall, we're taking a look at a snapshot largely before the Iranian war took place, before the repercussions. Is your concern now, if household spending was weak in Q1, is there a risk that we're going to see a repeat of that in Q2 now that we're dealing with higher gasoline prices and everything else?
Yeah, I mean, the fact that excuse me, we did see an advance in household spending. It was weak, but we did see an advance in household spending in the first quarter. So I think that's good news. We are expecting it to slow in the second quarter. We had a contraction in retail sales volumes in March, and it looks like we're going to see the same thing in April if StatCan's correct. And so certainly we are seeing weakness, and a big part of that, as you say, is the Iran conflict story, higher energy prices, and inching up higher, broader prices really puts pressure on a lot of households and leads to less discretionary spending elsewhere in the economy. And so certainly that's going to have an impact, but certainly not the sort of delta we typically expect between where consensus is and where the final numbers come in from StatCan.
And is there any one thing that stands out that dragged it down that much, or is it just kind of across the board?
Yeah, I think looking to the data quickly here as it's being released, I mean, a big part of it really, a big chunk of it was on the government side. We'd pointed out before that, the StatCan really seemed to have been baking in very high numbers in the second half of 2025 around defense spending for the federal government, and we thought that they were doing that incorrectly. We saw that it dropped off considerably in the first quarter of this year, and so seems like there might be some reconciliation happening here between the big boost we got at the end of last year and how StatCan's now calibrating these numbers. So that's part of that story, certainly. But res structure is also down. We're seeing a lot of weakness in the Canadian residential housing sector. Part of that reflects both the interest rate environment that we're in now, the broader economic environment, and the fact that still in Canada's some of Canada's largest cities, they remain unaffordable despite the fact that we've seen home prices come down. So overall, it's very much concentrated on the government side and the investment side of domestic demand, and certainly something worrying when we start seeing these kind of numbers coming in, particularly 2 consecutive quarters of negative growth.
So we now have 2 consecutive quarters of negative growth, minus 0.1, minus 0.1. I think that's well within the realm of statistical discrepancy. I don't think anyone should be rushing to say that we're in recession, but there's going to be calls that Canada might be in a recession. What are your thoughts?
Yeah, I think you're going to see some analysts rush out and start shouting recession, certainly, because it's the easy thing to do. But at the end of the day, I think I need to spend a little more time unpacking these numbers to have a little more certainty around how broad-based the drag has been in the last couple of quarters. But generally, I mean, the domestic demand story is worrying on that front. But the fact that consumers were spending in the first quarter, and that looked pretty healthy, certainly isn't necessarily grounds yet to make that call. So we'll be unpacking this throughout the day and probably come up with something more definitive in the next few hours, if not early next week.
And is there another time where you've seen that number? Because I'm seeing you shaking your head when you're looking at those two numbers there. When you've seen that combo before?
Oh yeah, I've been around for a while, and think back to early 2015, and a much younger Randall making a recession call at that time, it wasn't definitive. And I think what we've seen since then is that the C.D. Howe Institute has taken several different approaches, waited until the data was revised, and firmed up its view that ultimately early 2015 was not a recession in Canada because the drag on the economy was not sufficiently broad-based throughout various industries. And so, we'll have to take a look at this and get a sense of how broad-based this impact is to really make that definitive call as to whether or not the Canadian economy is in a recession. But at this point, I think it's too tough to call.
So, Randall, I'm a little bit older than you, so I come from a time when we weren't allowed to use the word recession on air. It was banned. So what are the positives that you see going forward that can get Canada out of this malaise, or are there any?
Yeah, I think there are certainly some positives. I mean, when we look at higher energy prices overall, we expect it will boost, energy production somewhat. Not as much as maybe in the past, but certainly that'd be the case, particularly in energy-producing provinces, Alberta, Saskatchewan, Newfoundland, and Labrador. We'll see additional investment in those sectors early on in trying to increase output as much as possible to capitalize on the higher energy prices, but also to, subsequent to that, greater investment and pressure on politicians to get investment moving on increased transportation of energy to markets, particularly Asian markets, via a pipeline to the West Coast. We will be getting on the consumption front. Many Canadian households, low and middle income households, will be getting checks from the federal government next week, so June 5th, to the total of $3.1 billion in checks going to households via the Canada Groceries and Essentials benefit, which is going to provide, we think, a bit of a tailwind to the economy in the third quarter, particularly household consumption, as much of that is likely to get spent on consumer goods and services. So certainly that's going to be a bit of a positive. So I think, a combination of, a little bit more on the investment side potentially in the energy sector, and then a little bit more on the consumer side coming up. But of course, we're heading into the CUSMA review, which comes to a head on July 1st. And so really that's going to be, it moves us into an era, I think, of greater uncertainty as we're likely to move to annual reviews. And so there will be potentially some additional weakness on the manufacturing and equipment investment side of things going forward as well.
All right.
So some good news, but some offsets as well.
Okay, we got to wrap it up there, Randall, but always appreciate the input of a grizzled veteran. Thanks very much for joining us. Have a great weekend.
My pleasure. Thanks so much for having me.
Randall Bartlett, Deputy Chief Economist at Desjardins Group. All right, some of the... And some of the stories we're following for you in the BNN Bloomberg newsroom. I jumped the gun there, got a little too excited about them. Laurentian Bank posted weaker than expected second quarter earnings as the bank set aside more money for potentially bad commercial loans. The bank says higher loan loss provisions weighed on overall profitability, with the bank's efficiency ratio also deteriorating significantly. Late last year, Laurentian agreed to be split up and sold, with its commercial operations going to Fairstone, while National Bank purchased the retail and small business segment. Shares of Dell are soaring in the pre-market after the computer maker gave an outlook for annual sales that far surpassed analysts' estimates. Dell says revenue in its upcoming fiscal year will be about $167 billion US, including $60 billion from the sale of AI servers. Dell's servers designed to run AI workloads are attracting customers from a variety of companies that rent computing, as well as corporate clients and major AI providers. Gap shares are down in pre-market trading as the company cut its full-year sales outlook. The clothing retailer fell short of sales expectations in its first quarter due to challenges in dresses at its Old Navy division. It says it did not have the right fashion and value equation. And still ahead, the U.S. and Iran have reached another deal on an extended ceasefire pending Trump's approval. We'll have the latest after this. And of course, our phone lines are open. Andrew Pyle is taking your questions on North American equities. Call us at 1-855-326-6266. or email us. First call at bellmedia.ca. There are signs of progress in the U.S.-Iran talks this morning with a new ceasefire extension under discussion, but key details still remain unresolved. We're joined now by Bloomberg's Tyler Kendall for the latest on this. Tyler, thanks for joining us. What are we looking at right now? What's the situation?
Well, Roger, at this point, we heard from the U.S. Treasury Secretary Scott Bessent yesterday briefing reporters at the White House saying that we perhaps have the, quote, makings of a deal. But at this point, nothing is final until there is sign-off. People familiar with the matter and sources do tell Bloomberg News that at this point, the two sides have reached this potential memorandum of understanding, but that they need President Trump to ultimately give his okay. It would appear, though, that we are moving closer to what would essentially be a phased approach towards ending the conflict. We would see a 60-day extension to the current ceasefire that would prioritize reopening the Strait of Hormuz. That means no tolls, no harassment, and that Iran would have 30 days to clear any sort of mines that are in the strait. Once the U.S. sees progress on that front, it's our understanding that the U.S. naval blockade would be lifted essentially in accordance, proportional to how much the strait is being opened. Once we have all of those components in place, then we would see that more formal dialogue kicked off about potential curbs to Iran's nuclear program and what happens to that stockpile of highly enriched uranium. At this point, both sides are signaling that we are perhaps the closest that we have been yet to this potential agreement. But at the moment, no confirmation yet. And I will point out, we got some headlines within the last hour coming from Iranian state media saying that reports of what is in this potential deal are not accurate and that so far nothing has been finalized.
Oh, my goodness. Okay, this is just the latest twist and turn with it. Have we heard anything from the president about it?
So I was actually in the cabinet room the other day with President Trump and the rest of his members of the administration, and he said that he wasn't satisfied yet with how the deal was shaping up and threatened that the risk of escalation is still very much on the table after we saw a flurry of strikes just the other day after Iran had targeted some commercial shipping in the Strait of Hormuz. We know that this White House, though, has long maintained that a diplomatic solution is a viable option, and it is what they would like to prioritize here. There is, of course, mounting political pressure domestically, but also the administration has wanted to make progress in terms of what potential curbs on Iran's nuclear program and Iran getting a nuclear weapon could look like. At this point, we're going to have to wait and see. Ultimately, it is waiting President Trump's sign-off, but he told us in the cabinet room earlier this week that the Strait of Hormuz needs to be prioritized in any deal, that no country can ultimately have control over that critical waterway. But in recent days, we've seen Iran try to really tighten its grip, instituting this new authority to oversee shipping in the strait and trying to impose what they are calling navigational services fees, but what feels like a rebranded toll system. In fact, you had the U.S. Treasury Secretary Scott Bessent yesterday say the U.S. has warned Oman, which apparently has been working with Iran on some sort of payment system, that any actors that are linked towards facilitating such a toll would ultimately face very harsh U.S. sanctions. So it's clear the U.S. is keeping up the economic pressure, at least for now, until that deal is signed.
All right, Tyler, thank you for that. Bloomberg's Tyler Kendall. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a downgrade for BRP. Let's take a look at some of the notable analyst calls and recommendations for this Friday. Stifel has downgraded BRP to hold from buy, cut the price target to 85 from 92 due to massive structural uncertainties surrounding U.S. tariff costs and corporate risk. Despite BRP posting an across-the-board earnings beat for Q1, Stifel moved to a neutral stance based on several critical long-term risks. Canaccord Genuity has upgraded Tamarack Valley to buy from hold, raising the price target to $15. This upgrade comes immediately on the heels of Tamarack's major strategic announcement to divest its Charlie Lake assets, transitioning the company into a highly focused, pure-play Clearwater producer. Well, drivers in some parts of the country, including the Greater Toronto area, woke up this morning to some of the lowest gas prices we've seen in more than a month. And it's not just part of the latest fluctuation as uncertainty drags on in the Middle East. CTV's BC Bureau Chief Andrew Johnson has more on the dip and how long it may last and why drivers on the West Coast aren't getting any relief.
Varun Sharma is spending $500 per week right now gassing up his cab.
Still lucky I'm driving hybrid, but it really hurts.
But after months of eye-popping prices fueled by the war in Iran, drivers in many parts of the country are getting a bit of a break.
Finally, a little bit of good news when it comes to filling your tank.
Drivers in Toronto were greeted this morning with $173.9 on the sign, the lowest price since April. The reason? A drop in oil prices over optimism the U.S. and Iran are close to a deal. And issues at refineries in the U.S. Midwest that supply Ontario have now been cleared up. As drivers in many parts of Ontario and Quebec revel in this dip on the gas price roller coaster, here in Vancouver, people are still paying on average well over $2 per litre. In fact, as prices fall back east, they're actually rising on the West Coast. What gives? Experts say it's now BC dealing with refinery trouble. A disruption in California coupled with Canada's highest gas taxes have forced people at this station to cough up $2.14.9 per litre.
How much does it cost to fill your tank?
Well over $100, like 130, 100 probably.
Finally, what Gas Buddy's Patrick DeHaan calls the million-dollar question, where people are paying less, how long could it last?
100% contingent on what comes of these negotiations between the U.S. and Iran. There probably has not been such a major impact to supply in my career, exceeding 25 years.
It's no million-dollar answer, but the one Canadians will just have to live with. Andrew Johnson, CTV News, Vancouver.
When we come back, Andrew Powell takes your questions on First Call. Time for First Call, and that honor belongs to Emmerich, who's calling from Edmonton. He's up early. Emmerich, how are you? What's your question?
Yes, bought some HPQ, and does Andrew have any projections for increasing their sales, their net income, and their free cash flow, which is going to be targeted around $3 billion for next year? And they pay a 4.5% dividend. What's his thoughts on HPQ? Thank you.
All right.
Yeah,
Thanks,
so HP recently reported pretty good quarter. I mean, consensus was 71 cents. I think they came in at 86 cents, so that's a pretty decent beat in anyone's books. The stock has pushed higher, but again, it's not a sexy stock, right? I mean, once upon a time, we would put HP and Dell in the same conversation about where are these two positioned for AI. I mean, HP right now, yes, printers and all that, but I would say it's old technology. Stock's done well in the last little while, but I don't think it has the same growth opportunity or growth potential as we see in other groups.
What would you need to see from it for it to break out?
Well, I mean, more quarters like this. I mean, investors obviously are happy with the results that we saw this week. We've seen it in the stock price, but we're still way back from the highs or the recent highs that we had. So I think you've got to see a couple more quarters like this to get analysts really excited. But again, as we've talked about before, where's the money going? Follow the money. That'll tell you what stocks are going to perform well. And I'm not so sure the money is really flowing into companies like this.
All right, let's get to some emails before we run out of time here. Umesh, can I have Andrew's opinion on Savaria, as there was discussion about the aging population as a growing theme on your show this morning?
Yeah, and I mean, this is another company in that group. I mean, this company specializes in basically putting together those I call them rides up the staircase.
Yep.
Or if you're behind a car on the street and you see Savaria on the back bumper, it means they've got one of those lift devices. They're going to capitalize as well. People, as they get older, still want to move. They want to do things, right?
Absolutely.
I have an old client in Peterborough. Whenever I go to her house, she wants to show me her Porsche. Well, guess what? The Porsche is built by Savaria and it rides up the stairs. So, just kidding.
It took me a second. I was like, Porsche up the stairs.
So again, the stock has done well. I would say the long-term run for this or medium-term run for this is still positive.
Is it a moat almost, that one? Savaria? Is Savaria is it a moat really?
In a way. I mean, all these companies are going to have competition, right?
Yeah.
From other countries. So, I mean, when we buy these stocks, be mindful of the fact that, we're not talking about revolutionary technology and getting someone from the bottom of the staircase to the top. But for now, this company is well positioned.
Name brand matters. Okay, let's get an email in from Ryan. Micron still a buy, or did I miss the boat?
I don't know. Did we miss the boat on Dell? I mean, Micron.
Let's not talk about Dell.
So here's my take on Micron. So Micron is really in the memory business, memory chip business. Yes, has the stock done really well? The stock has done great. Problem with Micron, it's facing a lot of competition from Samsung, which again is ramping up because the price of memory chips have just gone through the ceiling. So if you want to dominate in that, you're going to take home a huge windfall. So that would be my concern right now. This stock is, as you can see on the chart, is run extremely hot. 1 year return, 858%. Wow. This might be getting a little hot right now. So I don't know if I'd be buying. Well, I definitely would not be buying it today, but I'd be mindful of the competitive threat that Micron faces.
Okay, we'll wrap it up on that note there. Andrew, thanks as always for joining us.
Always a pleasure.
Have a great weekend, sir.
You too.
And thanks again to Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy for joining us. The Open's next. Trading gets underway about 30 minutes from now. Have yourself a great Friday and a great weekend.